Yo, so today's date, 19 March. Uh, it's just the morning now, so this price action is gonna be based on yesterday, so Wednesday, 18th March. Okay, I just make it soft. Yeah, so main subject is gonna be how to trade liquidity sweeps. Okay, very simple. Before we move on to practical assessment, you have to understand that a liquidity sweep can only happen if the market is already trending, okay, or is about to trend. So a basic format would of course be an uptrend, like this example here. We have highs that are being broken with impulse, like so, from here to here. Another break, another break. Okay, once you can identify something like this, specifically on a high time frame like the 4 hour, maybe the daily. The thing is, with the daily, you can identify these trends, but understand that what we are looking for, it won't occur very often, specifically during the week. Whereas when you spot it on the 4 hour, you will probably see this happen at least 4 times, maybe even more, maybe a little bit less. Okay, so very important here that the prime liquidity regions or areas for this market type would of course be these lows over here. Okay, and the significance of these lows are that they are higher lows. So in an uptrend, the liquidity is only resting beneath the higher lows. Okay, as you can see, this low is higher than this one, this low is higher than this one. Okay, very important. Vice versa for a downtrend. Today's video is going to be like based off of a uptrend, so I'll just give you this basic format on a downtrend. I'll try to find it on the real chart. Same thing here, we have lows that are being broken. Okay, and then we have the highs where the liquidity is resting. So once we identify uh, these things, we can then move on to the next step, right? So for instance, let's take a an uptrend. We first have to wait for the market. Let's say price is over here, the market needs to push down and grab at least one of these lows. It can be one of them, or it can be two of them, or it can be all of them. Okay, just the most important part about this is that once the market pushes down, grabs the liquidity, this is where we will then look to get involved. Okay, because this is an area of execution, and this is where we have to sort of start paying attention to price. Very important, because a reversal could potentially happen here, and we could eventually get in for a buy. Okay, vice versa for a sell. As soon as the market pushes up, grabs the high, understand that we are in an area of execution. Understand that price could easily reverse anytime after grabbing liquidity to continue the trend to the downside. Okay, so that's a basic format. So let's go to the real chart. Okay, so I'm gonna use the 4 hour, pretty good median long term time frame. And yeah, so the way I analyze is I look at every single candle. Okay, and of course we can see, let's say from this point here, I will do analysis. Okay, so here we have a break of a low. Okay, and then another break over here, another one over here. I used the wrong one. Let me just change all of these quickly. Okay, so here we can clearly see a good example of a downtrend. Okay, and each of these highs, okay, here's liquidity resting above each of these highs. Okay, and then here as well is a lower high. This is a lower high because this high is lower than this one. Okay, so all we have to do is we have to wait for price to push up, grab at least one of them, and here the market grabbed this one. Okay, and then anytime after that the market could potentially reverse and go to the downside, as we can clearly see right here. Okay, so how would we have traded this market? Very important. Once liquidity is swept, okay, price pushes past it, we're looking for buys now. Very important that we combine this with a SMC concept, a smart money concept, like a order block, okay, or a fair value gap. Okay, I don't usually use fair value gaps, but these are points of reversal where price could just easily interact with before moving up. Okay, so for this instance, when the market grabbed this high over here, we can see a 4-hour order block chilling right over here. Okay, and then we can clearly see the market rejected that 4-hour order block, and then the market pushed to the downside. And you know, the direction is very clear. After that, we can look for a significant entry. You know, however you enter the market, a candlestick pattern, just obviously don't enter immediately. Just wait for some form of how can I say, the market maybe breaking support, breaking resist, you know, in this case support, because we are selling. Here we can clearly see market pushes here, and pushes here. Maybe you just need two confirmations to get involved, or you just wait for like a candlestick pattern, like an engulfing candle. Here we can clearly see on the 4-hour the market just pushed here, engulfing candle. Maybe we can take a sell over here, stops above the high, and then aim for the ultimate low. Okay, ultimate low would, in this case for this market, would be this low right here, because this low was the start of that impulse after the liquidity got grabbed. So we can easily just aim for this low right here. However, this is not always the case. It's very important that you have a sophisticated RR across all your trades. Let's say for instance, once the market hits 1 to 1, we can at least go break even. 1 to 2, maybe we trail our stop as the market is moving, because it's not gonna always be like this. Okay, now for this, let's talk about a uptrend example. So here we have a high, okay, which was first a lower high. As you can see, this high is lower than this one, but here we had a break. Okay, this high, of course, we could still take a sell after this liquidity got grabbed. We could sell somewhere here, as you guys can see. Okay, but here we can see the market swapped. So here's a high that got broken, here's a second high, another one. Okay, so of course the resting liquidity would be beneath these lows. Liquidity here, liquidity here, liquidity here as well. So this is an example of all of them getting broken. Now in this case, we can see that the market had not reversed, except here the market clearly reversed now to the upside, but this was on the open, but we do not trade this time. But here we can see that the 4-hour did not show any form of reversal, but if we zoom in on lower time frames, we can see there has been forms of reversals. Okay, and these moves can easily be a 1 to 2, 1 to 3, depending on our time frame entries, right? Okay, so here was the first liquidity, so I'll be watching the price after that. So the moment the market had given me this break of structure right here, off of this high, right? This is very significant, because will I get in immediately? Maybe. Or I could easily just wait for the market to push down and grab the liquidity beneath this low. This is a more advanced theory, and then maybe get involved somewhere here, okay, for a 1 to 2. Very simple. Very important that when we are trading NAS 100 USD, we take these trades during the timing window, which is of course the New York session. As you can see, this trade was placed during the New York session. As soon as the market grabbed the liquidity here, we had a breaker structure on the 5. Here's no breaker structure here. We then waited patiently for the market to push down, grab the liquidity beneath this 5-minute breaker structure, got the confirmation right here. There's the 1 to 2 trade. All right, but I'm sure there is any form of entry that you could probably find here that you got probably taught on YouTube or wherever. Maybe in a golfing candle right here. Here's an entry right here, 1 to 2 there as well. And then also, if you maybe take trades off of the 1 minute, you would probably find something here as well. But just understand that after this liquidity, here was demand for buys. Okay, even though the overall push was down, but the impulses could all be money, right? But yeah, that is the video for today.